This graph from the Office for National Statistics shows a major worrying problem in the UK. We are not building enough houses, and sadly, it's getting worse with the lowest levels ever over the past few years and an expected slowdown as house builders slow down their building to weather the storm ahead. First-time buyers are facing an affordability crisis not seen since the financial crash of 2008, with new homeowners on average in the UK spending 40% of their take-home pay on mortgage payments, according to this graph from Nationwide. Let's be honest, it's a bloody nightmare right now for buyers, especially first-time buyers. You spend all these years saving up a deposit the best you can, only to experience multiple once-in-a-lifetime events just in the past 2 years alone. House prices are at their record high, interest rates are incredibly high with them, making houses very expensive and very unaffordable. Top that with minimal pay rises makes a very nasty triple whammy. The Bank of England warned that 750,000 households are at risk of defaulting on their mortgage payments. But what do they define as high risk? Well, according to the Bank of England, an at-risk household is any of those that spend 30% of their income on the mortgage payments. It doesn't mean they will default, but it means there's an increased chance if they don't take proper precautions like cutting back on other spending. Hang on, wait. That last graph that we just looked at, remember that one? The 40% of household income? The average spend on mortgage payments is 40% at the moment, but the FCA is saying those at risk are those spending more than 30%. That means when you draw the line at 30%, in the UK, the only real affordable places right now where you wouldn't be at risk, according to the FCA, includes the North, Yorkshire, Scotland, and Northern Ireland. And that's it. I look at that graph, and the first thing that comes to mind is how screwed millennials and Gen Z really are. But then again, being a generation that has been through some really tough economic times, when you combine it in context with that graph, it's really no surprise. The FT did some research and found that over time, as people get older, they tend to lean politically more to the right. That means as we get older, we become more conservative, usually because people have families, they have more wealth, they have bigger pensions, and they want to protect all of this. And traditionally, the Conservatives used to always focus on this in their policies and their mandate. But in the UK and the US, the millennial generation aren't following the trend. They're going more left as they get older. And this is something that we have never seen before in the past few generations since this data was collected. The Financial Times' explanation of this is a cohort theory. Their idea is that certain generations experience different lifetime events, where millennials have experienced different economic downturns and struggles compared to the boomers and the silent generation, and this experience has shaped their views politically. In context, looking at how financially screwed millennials are, it sort of makes sense. We have less wealth and less money overall compared to our previous generations, and millennials are having less babies for various reasons. So when you combine that with numerous political scandals, unstable cabinet officers and MPs who openly admit that they've spent more money subsidising private rail companies for strikes than what it would have taken to settle the strikes by fair pay in the first place, it's no surprise. Even before Truss, 2/3 of millennials had decided since the EU referendum that they no longer wanted to vote for the Conservative Party, and 1 in 4 now saying that they strongly dislike the political party. With millennials and Gen Z most likely to cast more votes at the next general election than the boomers, this is a real concern for the Conservatives. It means our vote will have more of a sway than ever before. And to reverse a generational cohort back in your favour, you have to do something rather drastic as a political party to win the hearts and minds of those people. Like, for example, improving home ownership and once and for all sorting out that problem for this generation, or for example, fixing what is one of the most expensive childcare systems in the world. Anything beyond that won't be enough. So we're at this pivotal moment where the housing market has to change. On one hand, the government may step in, something incredibly drastic, never seen in recent history that massively helps home ownership and affordability. Or B, they choose something else or do nothing, and they let the whole property market crash and burn, where it continues in this constant spiral of unaffordability. The reality is we can't just keep lingering in the middle. Something has to give sometime soon. And that's why I think the property market is never going to be the same again. So how does all of this impact house prices? Well, in the comments, I do see some people fearmongering that house prices could crash more than 40%. But What is actually happening and what is the data saying? Well, The Economist believes that Britain is in a very good position to weather a downwards turn in the property market, mainly because compared to 2008, banks are better capitalised and mortgages go through stricter stress tests for affordability. In 2007, over 15% of mortgages had a loan-to-value greater than 90%, meaning buyers were highly leveraged. Nowadays, that's around 4%, so a lot of people have more equity in their own homes to weather downwards prices, and thus protecting them greater from the threat of negative equity. And also, the average loan to value has dropped from 80% before the financial crash to around 77% these days. Not a huge difference, but it does mean that on average, people have more money in their own homes. It's not the most reassuring data in the world, but it does show that we're in a better position today than what we were in 2006 and 2007 before the financial crash in 2008. The Lloyds Banking Group CEO said at the World Economic Forum that there is a tale of two sides here. Lloyds own Halifax, and they are saying that they expect an 8 to 10% drop in property prices over the next year. But interestingly, they're only expecting 1% of their customers to require special needs based on poor affordability, albeit not ignoring a very large pot of customers who are having to change their spending habits just to survive in the current economic market. But they did also comment there is higher resilience in the commercial space, residentially, where we can weather to some degree the increase in rises that we've seen so far. Based on that, property prices have to come down. We've had a very hot market over the past few years, and at some point that has to cool. But I don't think we're going to see an almighty crash just yet. It's definitely going to go down, but I don't think it's going to be as bad as what people think it will be until you look at the data and the stats. And when you look at this fantastic graph from housepricecrash.co.uk, this shows house price increases adjusted for inflation. That means that if inflation this year is 10% and property prices have also gone up 10%, the actual net increase is zero. And when you look at it that way, things get really interesting. Compared to 2006 and 2007, just before the major financial crisis, we haven't actually recovered in terms of house prices relative to where we were 15 years ago. So there's a chance, looking at it this way, that actually we might see a small dip now, but that might just be the trigger where it cools off enough to then explode and boom into what is the next explosive phase of the property market before the next major financial crash. I'm not saying that will happen, but it is an interesting theory that you shouldn't ignore. And I couldn't make this video without addressing and talking about the chronic problem, which is the fundamental lack of supply in the UK. The house builders have a huge monopoly over land in the UK. They may sit on it for a very long time, delay going through planning, and just let the land go up in value and build the houses at a time where it's more prosperous to do so. That means in economic downturns, house builders build less houses, which does not help our problem of property prices going up and up. Sadly, going back to the graph at the start, house builders are building less today than what they were 10 years ago. We still haven't recovered to our original house building figures. We've had a decade to do this under Conservative leadership, and it just has not happened. Things like Help to Buy, stamp duty holidays and shared ownership fundamentally are not helping the root problem here. They're focusing on the demand, but there isn't an issue with demand. There is plenty of it in this country. The issue is the supply, and the government always ignore this. So we have less houses being built every year, but an ever-growing population, and thus the very simple economic fact of supply and demand takes hold. So in conclusion, what should you do right now? Well, that is a really hard question, and my best advice is do whatever is less financially risky to yourself. If you find the perfect house, then go for it, as long as you're not putting yourself in any financial risk or strain that might mean there are issues later down the line. If you've got a super cheap fixed rate mortgage expiring this year, then do the maths now and consider your best options. Should you start looking for a new fix? Can you sit on a variable rate and weather the slight increases in the base rate expected this year? Or in the worst case scenario, have you stretched your affordability too far and you need to think about moving and downsizing to a cheaper home? If you're a first-time buyer, if you find a house that you really love, you can afford it and it's not a stretch, go for it. Keep your eyes on the market, keep looking at the data, ignore the scaremongering headlines, and if now is not the right time, then keep saving, keep building up that war chest of money, and at some point the time will be right. If you enjoyed this video, then check out this one here that has over 700,000 views, talking about whether you should buy a house now or wait until next year, looking again at all the facts and figures. Check it out here, and I will see you in the next video.